QuickBooks Pro Desktop 2021 Sales Receipt Form. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars practice file. We currently have the home page open. You could open the home page by going to the company dropdown, selecting the home page. We also have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list, and then see if it is collapsed or uncollapsed with this icon here. We're going to go ahead and collapse the open windows so we can see more of our customer section flowchart, the area we are focusing in on now. Remember, the customer section is going to be the flowchart that you could think of when thinking about the sales cycle, the accounts receivable cycle or revenue cycle, different words for the same type of thing. When you're thinking about a transaction, you want to think about what cycle does it fit into, and then what form will be used in order to do the data input for that transaction. In this case, we're thinking about the create sales receipt form. And then once you look at that form, then what is going to be the transaction that will affect the financial statements in terms of the balance sheet and income statement or profit and loss? And then are there any subsidiary ledgers that are major subsidiary ledgers that will be affected as well, that will supplement, or not supplement, but will complement or support the financial statements. So we're talking now about the sales receipt. This is going to be similar to the invoice. So the invoice, you'll recall, will be entered when we make a sale, but we made it on account, meaning we did the work, we did whatever we need to do for the work, providing the goods or doing the services before we received payment, and then expect receiving payment in the mail. Therefore, the invoice is going to be creating an increase in the accounts receivable account, which will then be decreased once we receive the payment by the customers. Now, if you think about those two items being completed, then we're basically at this point in time, which is where the create sales receipt will be, because the create sales receipt, we're imagining a situation where we're getting paid at the same point in time that we do the work. Something like if we had a cash register, someone brings up a guitar to the cash register, we ring it up at that point in time. We've done the work, we provided the guitar, and we got payment at that same point in time. This would often be the case for like restaurants and stuff where you're going to get paid at the same point in time. You could imagine this as the form that would be used, the data input that would be used when you're checking out something at a checkout at a cash register and you're providing like a receipt for that item. What's going to be recorded when you record this form? If it's a service item, and let's think about inventory later, we will think about inventory in a second, but the standard items that will be recorded, whether service or inventory, will be an increase to some type of cash account. The other side is going to be an increase to some type of revenue account. So the create sales receipt form means that a sale was made at the same point in time that some type of receipt of payment happened. Therefore, some type of cash account is going to go up, and the other side is going to go to sales or revenue, affecting the income statement side of things. Now, note that the increase in the cash side is often the confusing component, because once again, you got to think about, well, do I increase the checking account directly, or should I put it into undeposited funds first and then deposit them later? If you are having a situation where you're getting a lot of sales and using the sales receipt, oftentimes the undeposited funds is the way you want to go, because if you're selling something like in a store, then you might get cash sales, or if you have a restaurant, you might have a lot of cash sales that you are going to be receiving, and therefore, if you were to record them into the checking account every time you got a cash sale, they would appear on your books as each individual cash sale. If you're selling like $5 items, you'd have a whole bunch of $5 item deposits on your side of the books. But then when you reconcile to the bank statement, they will show up on the bank statement as one lump sum number, because they will show up in the same type of formatting as you group them in when depositing them into the bank. Also, if you have different kind of sales transactions at the store, like credit cards, cash payments, and check type of payments, then again, those three things are going to be grouped together differently. The cash payments will all be grouped together as you go to the bank and deposit them at one lump sum. The checks might be in there individually as you put the checks into the system. And the credit card payments are going to be grouped together in the format as the third party, the credit card company, will be grouping those payments together, possibly grouping multiple customer payments together. So you want to be able to think about that, and that's when the undeposited funds will be useful. So this would typically increase then undeposited funds, a form of cash, but not yet the checking account, which you would then use the deposits item, as we saw in a prior presentation, to make the deposit using this little to indicator, which is an indicator that we got payments from a customer, either from the receive payments forms or the create sales receipts, that we can then group together in whatever format is appropriate into our account so that we can match them up to what will be on the bank statement. So in other words, if I select this item here, we've got our two little pop-ups that will then pop up, and these could be coming from a payment or a sales receipt, right? And then we could select these two items and group them together as necessary if needed. I'm going to close this back out, close this back out. So here we're going to go into the create sales receipts. And again, I would imagine that we're at like a check register and we're entering the create sales receipt item here. I'm going to go back to a prior sales receipt that we had in the past. So here is a sales receipt. So the sales receipt up top, again, means that we got payment at the same point in time that the sale took place. And you have up top then the deposit to undeposited funds. Now, this item will only be here if you have the settings set up to see this option to be able to deposit to undeposited funds or the checking account. In other words, QuickBooks will have undeposited funds at the default and not even have this option here, which you might want to be the case if you're working with someone else to do the data input. In other words, if you have multiple people entering a sales receipt, you want to make it as easy a process as possible. If your process goes through undeposited funds, you may not even want this window here because they may be likely to change this to the checking account, which you don't want them to do. You want them to just keep it where it is. So in order to see that, I'm going to close this back out and look at the options to see that option. If you go to the Edit dropdown and go down to Preferences, we're in the Payments section, Company Preferences. This item right here will typically be checked off by default. I'm going to check it off now just to show you what that looks like and say OK. And then we're going to say OK. And now it closed all my windows, so I'm going to open up the Company dropdown, Home tab, maximize the screen, and then I'm going to go to the Create Sales Receipt again, and then go to the Prior Sales Receipt so we can see that same sales receipt. Now that window showing undeposited funds is gone. So that means that this sales receipt, you know that it's going to be increasing some kind of cash. The default's going to be going to undeposited funds, although you can't see it here. And then the other side is going to be going to sales, and then we'll talk about inventory as we go. So in other words, you have no option not to go to undeposited funds right now, which might be useful if you're having some other people do the data input and you want to make sure that they put it to undeposited funds and simplify the data input on the form. However, if you would like to deposit this directly into the checking account, which may be the case, for example, if you are receiving a check, which you know is going to hit the bank statement in the format of one payment from the customer in the format of a check, then you might want to put it directly into the deposits or the checking account at the point in time you make the sale, so that you do not have to take the added step of then making a deposit next time. So in other words, if I close this back out, if I deposit this directly into the checking account, then I don't have to go over here and do this step at all. I could just deposit it directly into the checking account here. But I only want to do that if it's going to be going into the checking account payment by payment, rather than grouping the payments together as they will be seen on the bank statement. So I'm going to change that setting again, Edit dropdown, Preferences, Company Preferences into the Payments section, and then I'm going to uncheck this item and say OK. And say OK. It's going to close all the windows again. So I'm going to go to the Company dropdown, Home Page, maximize the window, and then go back into our sales receipt, back into the sales receipt. And then I'm going to say the back arrow. So there's our undeposited funds. If we wanted it to go to cash, to the checking account, we can select the checking account up top. Then we got the customer sales receipt. Now you can customize this form as well. And this is a form that you might be providing to the customers. So therefore, it might be nice to make a custom template of the form and add your logo and that kind of thing. We won't get into that now. We'll talk more about that. We might get into that after the whole practice problem. So we'll get into the logistics of it now, and then we'll talk more about like making the forms look nicer and customizing them possibly after the practice problem. Then you've got the form of payment. This doesn't really change what the statement will do in terms of recording it to the financials, but it might be useful for you to use as a reference. So you might be getting cash, you might be getting a check, credit card information up top, e-check. So again, that could be used basically as a reference. Then we have our date up top. We have the sales number typically generated automatically. Sold to Garcia. If there was an address down here, we can add the address. Note that if these are sales made in your store, it's less likely that you're going to have their address because it's less likely you need to mail them anything. But as you add the customers, and note you could be adding customers here as you create the form. In other words, if it's a new customer that comes up to your check register, your cash register, you could add the customers as we have seen in the past by going to the customer center, or you could just add the customer as you go through this form, which could be useful. As you add the customer, you might want to pick up more data for the customers as much as you can so that you can then have contact information for that customer, give them your newsletter and all that kind of stuff. Then check number down here, if applicable, that's going to be the check number of the check that you would be receiving if you were to receive a check. And then we have the item down here. Now, this is just like the invoice in that if you set up these sales items properly, then the data input to actually create the sales receipt will be easy. If you imagine this process, you want to imagine someone in a store making sales receipts that doesn't need to know anything about the items or how the items were set up. They don't need to know anything about what this sales receipt will do in terms of the impact on the financial statements. They just need to know how to ring up this thing and collect the money on it. And if you set everything up properly, as we will see later, setting up the items is going to be one of the most complex kind of components of it. We'll set up the item properly, then this will be really easy to make the sales receipt. In other words, if you imagine someone bringing up like a guitar that they're buying to the sales receipt area, as long as you have that guitar in the drop down and set up properly, then the person checking out just needs to check off that guitar. It will then ring up the rate and the sales tax on it automatically. And they don't need to know what the item is doing. They don't need to know the effect on the financial statements. However, when you think about it, you want to be able to know those things so that you can set up the items properly and the sales receipt properly. Now, if you don't have any items, you could just write in these amounts, but that's going to be, again, a lot more time consuming to do. So it's best to set up the system properly at the beginning. That's going to save you a lot of time. So what would this do then? What is this going to do in terms of the financial statement transaction? Well, it's a sales receipt. It's going to increase some kind of cash. The cash is going to be undeposited funds in this case. It's going to increase that by the full amount, in this case, including the sales tax, because we are selling an inventory item. If it's a service item, in the US, we may not have sales tax, and the sales tax will be, we've talked about how to set that up in prior presentations. I won't get into that now. But it's a state or local tax, and it'll change by the state or local area. And so we're going to get the whole $525 payment now in some way, shape, or form. And then the other side is going to go to sales, just like the other side. The rest of it's just like an invoice, right? The other side is going to go to sales. The sales amount, however, is only going to be the amount we charged, which is $500, which is driven by the item. Set up by the item. The difference between those two is going to be the sales tax. Remember, the sales tax to 25, although we're going to be getting that, never hits the income statement because we are just the government makes us their tax collector. It's not our income. We're not recording it as income. We're not recording an expense related to sales tax. They're just making us the tax collector because they have leverage on us to do so. So we're going to say, all right, we collected the sales tax. That increases the payable of sales tax, never increases the income statement. Then we also know if we're selling an inventory item, that inventory is going to be decreasing by some amount that's not on this form because we don't want to show it to the customer, and we might provide the customer this sales receipt, but it's driven by this item. So let's just take a look at the item real quick by going to the lists drop-down, item lists. This is an ELP, so we set up the ELP here. If I double click on the ELP, we set up the cost of the ELP and the sales price already. So it's going to deduct the inventory by the cost automatically if we set it up properly, closing this back out, closing this back out. So this is going to be decreasing the inventory item. That will only happen if we're tracking inventory in the system. If we are, we'll be using a perpetual inventory system, weighted average inventory method. If you're dealing with inventory and you don't have a good idea of it, I do recommend looking into inventory systems. And we do have a financial accounting course on that just to understand the different systems that are there and how you can then work the best system for you. But if you're tracking inventory, then it's going to be tracked in there. And then the other side is going to be the cost of goods sold, the expense related to us consuming the inventory at this point in time in order to generate the revenue of the $500. So also note that the subsidiary account of inventory is going to be there as well, that will track not just the dollar amount of inventory, but also the amount of inventory, the units of inventory. All right, so let's take a look at that. Let's check that out. I'm gonna close this back out, and let's open up our financials. I'm gonna open up the windows to the left. I'm gonna go to the company drop down. Gonna go to the company and financial down to the balance sheet standard. Changing the dates up top from let's make it from 01/01/21 to 12/31/21 and say okay. All right, so the basic thing that's going to happen is we're going to say, well, the cash is going to go up, either the checking account or in our case undeposited funds whenever we have a sales receipt, selling something like at the cash register. If I go in there, anything that says sales receipt, then those are going to be the increases that to the cash here. So we got the two sales receipts up top. If I double click the sales receipt, that takes us to a sales receipt type of form. And here's our sales item. I'm going to close this back out. And let's take a look at the other one. Here's the sales receipt type form. And we sold this Epiphone semi-hollow body for the $400 plus the sales tax for the $420. So notice we have the full $420 here for that item. That's on $116. The other side would be on the income statement, or the P&L, reports drop down, company and financial, profit and loss, changing the dates up top from 01/01/21, 12/31/21. And we're going to go into the income for the sales item because we're selling inventory. And we see the sales receipt on 116. Notice it's only there for $400. That's the amount that we charged, not including the sales tax. The difference between those two is $20. That's going to be on the balance sheet again as a payable. That's what we owe the government because they made us their tax collector. By going back to the balance sheet, we're going to go down to the payable, and we're going to say we have sales tax payable, double clicking on that item. Once again, the sales receipt here for that $20 difference. Closing that back out. We also know that the inventory is going to be decreasing. So inventory is going to be decreasing up top, double clicking on the inventory. So let's focus in on that same one where we had the sales receipt here. And notice it's on the books for $320. That $320, if I double click on that item, is not on the sales receipt. Why? Because I don't want to show it to the customer if we provide the sales receipt to the customer, although the sales receipt, if we're tracking inventory, will drive the decrease of the inventory by the use of the item that we set up here. So I'm going to close this back out. The other side of that will be on the income statement, profit and loss statement, and the cost of goods sold. Cost of goods sold, there's going to be the 320 decrease in that. So the effect on the income statement would be the amount that increased sales, the 400 I believe it was, minus the cost of goods sold. I believe the 320 would be the net effect on the income statement of that particular sales receipt. Also note, if we go back to the balance sheet, that we had decreased inventory by this, and if we're tracking inventory within the system's going to be using a perpetual system weighted average inventory, as we'll set up when we work this practice problem. We're going to go to the reports drop down, inventory. We'll take a look at the inventory valuation summary as of 12/31/21. And there we have our inventory at the 944, tracking not only the dollar cost, but the units of the inventory on hand, which is the key point here. That 944 cost should then match what's on the balance sheet at the same date, that 944 in inventory. Once we then have the undeposited funds, of course, the next step, if we go through undeposited funds, would be to deposit them into the checking account. If I go back to the home page, this number 2 up here then will be an indication of the customer payments that we have received, either from the receipt payment or the create sales receipt that we would then deposit. Once depositing them, it would decrease the undeposited funds and be going into then the checking account.